Hey everybody, it's Mark here, and yep, Tesla did close in the red today. It was down 1.19%, which was a drop of a share price of $2.99. That closing price was $248.50. Now that closing price, considering it's a Friday, that is not too surprising. It's really just because this is kind of an options play. They were, it got to the point where we thought that the area, which was around $252.50, would have been a better strike earlier in the morning. And he kind of tried to form a base off that as it sold off the first time around. And it kind of bounced up. And it was kind of waffling back at around 252 again, but eventually fell through. And kind of at that point, if you were in a trade of some sort, you would have to make a decision. Like that was like near the closing price for the day before. Maybe you just kind of break even on your swing trade or your overnight hold and just get out. And that's what happened. Like if we were to kind of look at this a little bit closely, at that point, which was just around the price from the consolidation from yesterday, there were some really big orders that were being placed, being sold off and basically absorbing all of the liquidity that was in this area. And it broke through really, really quickly because they just didn't want to be in the name. Like if you weren't making higher highs after the initial sell-off, like there was really no point to try to hold into the weekend, expose yourself to risk. So it kind of makes sense that when you got to that price, you just have to make a decision. Are you just out? And I think a lot of people just got out at that point. And it fell to a dollar amount where the market didn't really want to pay the puts out, and that was going to be put for $247.50. And there was not much enthusiasm compared to other tickers that required much to maintain price right above that. There was no. I think the S&P 500 had a better rebound towards the end of the day. The S&P 500 has a better aftermarket performance as well, and it was just. Unfortunately, even with all the interesting news that came out for Tesla, there wasn't enough to get the market to buy into the name. And there could be a couple of reasons for that. And I'll do the charts first today so we can get to the news, and I can blabber about news that might not be that interesting to you towards the end of the video. So this is the chart. Once again, we figured that the 252 area would have been very interesting just because it would have been hell, that's even a flat day, not even that interesting. That would have been a flat day, and which was what I was wanting, just something not too surprising. But what happens is that when you kind of have this bullishness that gets above the upper EM, and especially on a Friday, like the whole point of a estimated move is that getting out of the estimated move will cost the market makers. It costs them a lot of money, and they're just not interested in doing that. So it causes a big sell, which kind of cascades, right? And you saw it breach just a little bit. It kind of fills the gap from a couple of days ago, and it just sells off the entire day. I believe the intraday from high to low intraday was 3.5%. 3.8%. So at the lowest, it saw a 3.8% decline from peak to trough. And so like if the market really wasn't severely selling off in the same way that Tesla was, because Tesla's beta is what 1.8. And it was, of course, underperforming severely during that correction. But you can kind of see it in a different way, where there was maybe just like a rotation within the sector to different tickers. And what would that rotation be? I think it would be into the legacy automotive names. I think there's a bet that's being made, or some type of pump that's being made for the market to enter shorts. And let's look at Ford. And this is Ford overlaid with Tesla. So I'm sorry, Tesla over Ford right now. So Tesla is in the orange line, and you can see it was selling off all day long. But what was happening to Ford? So they kind of started at the same point, right? And this is how I orientated the screen. They started at the same point, and you got that bullishness in the morning from Tesla, and it was trying to keep above water. But as it sold off, what did you start seeing? You were starting to see kind of bullishness in Ford, and it was almost like an equal ratio as far as peak to trough and trough to peak. Like if you were to measure like the low of Ford to the high of Ford, that was a 3.23.25% move to the upside, and it didn't really finish all that far away from that as well. It kind of was flat for the rest of the day. A lot of takers were, because when it comes to expiry Fridays, where a lot of options are expiring, for single tickers, like there's just not much motivation to move once it's gotten to the point where the market has determined this is what we're willing to accept as far as gains or losses to the options that they sold. So what about Tesla? So from the peak to the trough, Tesla, we determined that was like 3.8%. And as far as a close, about 3%. And how about just for shits and giggles, from trough to close for Ford, 2.77%. So you can see how it could be that, okay, so even though the UAW initial negotiations are not going so great. So Stellantis, Ford, and GM have all been rejected by the UAW as far as the increase in pay and benefits. I believe on average, I think it's somewhere around 17% of increase in pay for these legacy OEM people involved with the UAW. Even though it was rejected, the stock still performed well, considering that not but maybe in a couple days into next week, you could see these companies go into a strike and not have production. And what if this is like a rehash of the negotiations from before COVID, right before COVID? Is it going to be a couple weeks of no production for these companies? How does the market take that? Does the market say, okay, without production, without these facilities operating, and without the ability for those companies to bring in, temporary workers to fill in those spots, what is this, bullish or bearish for legacy auto? We really don't know how that's gonna really be perceived, because what if they have the inventory and it's not really that big of a concern, or is it really not even about the production? It's like, okay, ultimately, whatever agreement that's agreed upon, is it going to make these companies uncompetitive? That's remains to be seen. But if next week is a possibility of the first dates that the strike can be started, and you're trading this market, right? Wouldn't you want to enter shorts if you believe that the company's stock share price would fall because of the strikes? Wouldn't you want to enter shorts the cheapest way you can? How about you pump up every single car company, Stellantis, GM, and Ford, and then enter shorts there? Keep the price up, maintain the shorts, rotate out of your tech or Tesla positions, get out of NVIDIA, get out of Tesla, go into these companies, then enter your shorts in, and maybe have a couple percent ride down. That could be pretty lucrative. So it's something to think about, because fundamentally nothing really changes with the AI picture for NVIDIA. NVIDIA is down. Nothing really changes for Tesla in this whole day, but Tesla is down. Now there could be some, kind of like not particularly like financially fundamental when it comes to sales or profit for Tesla that's affecting its price action, and we'll talk about it when we get to the news. But yeah, there was great bullishness in the morning. There was a lot of great info coming out from Walter Isaacson's book that we'll talk about. But unfortunately, Tesla did not do so well. But I mean, for the week, I believe it's up like a couple percent, if I remember correctly. So we can just kind of take that. But it also kind of shows, like, even with really bullish moves if you're looking at this on a single day's performance, if you're like, let's say you're in a covered call, and we talk about covered calls and hedging your positions a lot. But there were moments where you're like, oh wow, like if you sold a covered call like early Tuesday morning, you'd be like, oh man, like I'm hurting a lot right now. But by the end of the week, you're perfectly fine. The stock is within the estimated move, and you're making money on theta being destroyed as every day goes on, and Tesla's remaining relatively flat. And of course, we're getting into next week. We're going to have a lot of data come in that can confirm whatever we might be seeing when it comes to softness and jobs. We can confirm when it comes to housing prices coming down, or from even a negative point of view, how our energy costs affecting inflation, and is that going to be a big negative for the market, and especially Tesla. But here's like our auto sector comparisons. You can see how, from a kind of a zoomed out point of view, I guess it's Tesla isn't doing so bad compared to legacy auto, right? We have Rivian and Tesla kind of performing really well compared to all the other names. So yeah, today wasn't so great, but legacy auto is not doing that great. What I want to do to kind of give you an idea of what legacy auto is doing, like, yeah, GM is up, Ford is up, Stellantis is doing okay. Just to let you guys know, like, even if I wanted to short, legacy auto, and maybe it is a good short if strikes were to occur. If you want to look at the overall chart, they're not doing like so much better than Tesla. If we were to go to the daily on GM, it's straddling this line and it's at the bottom of the range. Now you can kind of say this is a bear flag on GM and it would set up for a really nice short. And that short, what would that short look like? Probably into like the $20 range for GM. If things were to progress for a very long time. Like if you trade Google, for instance, Google last year kind of printed a very similar chart where it was kind of bear flagging in a kind of like a horizontal range. And here's your post, here's your flag. And so GM is at the bottom of this consolidation. Right. So it's like for GM and Ford to have like a 1 or 2% or 3% gain on a day, that's good for them. But when you zoom out, like legacy auto is hurting. They're not doing so great. They post, like, you can go back to their quarterly earnings and you're like, okay, yeah, they posted some good results. Their profit is up, which is unfortunately hurting their negotiations because, they're having great profit. Their CEO is making a lot of money. Executives are making a lot of money and the workers apparently are not doing so great in comparison, especially due to the kind of negotiations that were handled before COVID. No one anticipated COVID. A lot of lost earnings occurred during COVID without protections. With a pandemic like shutdown, the workers are kind of, left out in the wind. But yeah, like, okay, legacy auto has a good day. Maybe there's a rotation from, out of EV into these legacy autos because they're at the bottom of the range of consolidation. But every bear flag has a bottom, right? And eventually it falls through, and we're straddling that right now. So this is a period from, last May until now, and it's really going nowhere. I mean, let's look at Ford, and you can kind of see maybe a similar situation. Let's look at Ford. Let's go to the same period. So maybe spring of last year. Let's say spring of last year. Let's turn off Tesla. Tesla also looks terrible, really long, in a long time frame. But yeah, I mean, this is the same thing. You kind of have your post of your flag, and then you have this. I mean, it's not really a flag, but it could be a flag. It could be some type of like pennant, or long term, this could be a wedge. But this is right at the bottom too. Like, okay, 3% move, but when you're down from, let's say, the year's high is this July 13th, you're down 21% from your high in the summer just a couple of months ago. Like, it's only been 2 months, and you're down a considerable amount. So the question is, are we rotating out of Tesla? If you're into the automotive sector, maybe you were in Tesla because thinking that the UAW, they have this stranglehold on legacy auto, and you're just not wanting to be in that name. But if your stock drops 21%, maybe you de-risk enough. That's the question. That's the question. So something to consider. And even though, you can see that correlation between the action of Ford and Tesla, you got to wonder if that's just simply to enter some shorts. Is this going to break down in the future, or has this been de-risked enough considering it's been flat for such a long time after selling off considerably? Who knows? But what we're hoping for is that due to the negotiations, that Tesla would actually be doing much better in light of the fact that, okay, if their main competitors are being shut down for some time, at least 4 weeks, the UAW has about $900 million that they can pay out to their members during this strike, which is, I believe, $500 a week, if I heard that correctly. That is not exactly a lot of money, but they do have a lot of funding to try to get through this. We also do know that the Biden administration is trying to bail out the auto industry, providing billions of dollars in free money to kind of satisfy demands of their unionized workers, because of course Biden wants to appear like that his administration is affecting this in some positive way due to an election coming up and unions usually being very pro-Democrat. Anyways, So that's Tesla. Tesla is just kind of ranging for now. Well, what we want to see when it comes to next week is the index, especially maybe coming out of a kind of an oversold condition and maybe rebounding into Wednesday. Okay, so if you see some bullishness on like Monday or Tuesday, that could be your opportunity to enter some shorts. Sometimes it's better to actually enter a short in on the index, like S&P 500 or the NASDAQ, just because the type of options that you have could be more volatile and work in your favor if things were to sell off. That would be like entering a short on Tuesday to expire Wednesday or Thursday, because if you enter a short for Tesla on Tuesday and to hedge your position in Tesla and it expires on Friday, it doesn't necessarily give you the same move that you would want to kind of have as far as getting a good return on the capital you put into your hedge. So, unfortunately, Tesla's not doing so fantastic, but on the week it did just okay. I have no guess as far as what the action looked like on Monday, because you're going to have a long weekend. Not a long week. You're going to have a weekend of a lot of things that are going to come out. Walter Isaacson has a lot of interesting tidbits that no one's ever heard of, as far as the thought process that go behind Elon's decisions, the political perspective as far as like the Ukraine war and how he's being perceived and his influence on that type of situation. Of course, Elon Musk's attacks on the ADL needs to be considered as well. So there's all these things that are going on that are extraneous to Tesla that are, of course, affecting the sentiment of the stock, because it's kind of like when you talk to Tesla owners, when they're like, hey, what do you like about having a Tesla? What don't you like? And a large percentage of these customers that are buying Teslas have a big problem with the person leading Tesla. I personally don't. When it comes to politics, Elon and I see eye to eye on a lot of things. Not that I'm talking like I know him, but I see eye to eye with him on a lot of his political leanings. So it's not coming for me. But a lot of owners who are maybe more on the progressive side or who align to the left might take issue with a lot of what's going down. And Elon really going after the ADL, and as far as kind of having retribution for his actions during the Ukraine war with his decisions on Starlink, there's a lot of behind the scenes kind of stuff that can put pressure on Tesla, just for people who are wanting to enact some retribution. And you can kind of see that from this current administration. You see the kind of really petty lawsuits in regards to how SpaceX is on hiring refugees and asylees. You're seeing how the government's going after him. The DOJ, the SEC, is going after him as far as even like a lawsuit goes, and an investigation from the Securities and Exchange Commission about some glass house that Tesla might have thought about building for Elon, which is ridiculous. He can build his own house if he needed to, and Elon's never shown his desire to own and be in some fancy dwelling at all. That's just not the case. He's actually been pretty Spartan when it comes to his living arrangements from the looks of things, either renting houses or living in tiny houses. So so just something to think about. And that's why, in the short term, hedging is really, really important, because there's so many things that are going to be affecting the price action of the stock that will, unfortunately, it won't make sense from a fundamental perspective. It won't make sense from a performance of the company's perspective. And I can understand there's a lot of frustration when it goes to that. Just think about if you're an employee of Tesla, and and the reason why all these employees in Tesla are not unionized workers working in automotive factories is because the type of benefits they get from stock options, for just working at Tesla, could kind of sway them away from being unionized. But if the stock doesn't start performing, you start to wonder, like, hey, like, you remember when the stock dropped to like $100 a share last year, and Elon was sending emails out to his employees like, okay, so, try not to worry about the short-term fluctuations of the stock, but it's hard not to worry about it because, that's your compensation. And that's why you don't have the same benefits as a person working at GM or Ford or what have you. And I don't necessarily agree 100% with ideas of the union for auto workers, but you can't deny that, there's a possibility that employees want to see some performance from their stock, not just, given free stock as a benefit of working at the company, but seeing gains and growth in their investment in Tesla, and unfortunately, we're relatively flat. We drew this kind of diagonal trend line from the gap up from the island reversal, and we're still well above that. So we're not necessarily making any significant lows. It's not something that is really too troublesome. But if we were to move down the trend line to kind of rest below the lows that we hit on these wicks, maybe we can try to maintain some bullishness when it comes to this move. So going below the trend line, which we did and kind of rejected off it originally, wasn't necessarily a huge bearish thing, because at the end of the day, I think horizontals have more memory. I think horizontal, basically left to right lines are going to be more relevant to action. And you can kind of see that when it comes to especially Fridays or OPEX, it's going to be more important for the the levels of pricing than diagonals. Like no one's calculating the max pain or further for an options expiration day just because there's a diagonal line. No one cares about that. Obviously, you can see it was just horizontals. Like we're not paying onto 247.50. We gave up 252. We gave up 250. We gave up enough in their mind, and that's where they defended above 247. There wasn't much of a fight when it came to Tesla, so they didn't have to really do too much to really affect getting to that particular max pain. But yeah, so I mean, no new significant lows. That's kind of okay, right? Like you can try to draw some patterns up. Maybe you're seeing some type of triangle being formed or what have you. But if you want to try to compress price again, we got to the point where we thought, okay, we're getting to like a triangle here. Maybe this is a triangle here, and that's going to kind of explode out of it and explode it down. And so hopefully that was not the triangle that we need to pay attention to. But, right now we're just kind of moving side to side, making lower highs, still kind of keeping higher lows depending on the time frame you're looking at. So not so bad necessarily. We're going into a week with a lot of data. We're going to OPEX on next Friday, perhaps. So we have PPI on after CPI. So even we'll probably talk about this on Tuesday, but if we have a good move from CPI, sometimes it's kind of muted as the day goes on. Sometimes there's a quick reversal on CPI gains because they want a confirmation going into Thursday and Friday from PPI, and of course adjusting the levels of stock prices going into maybe a very large options expiration day for the month of September. Something to keep in mind, and we'll kind of brush up on that again. So yeah, not too great on the price action front, but I wouldn't say there's too much to worry about just based off the look of the action. But you'd wish that you'd make some significant highs, but it's not like we're well below the EM. We're not. We just rejected off the upper AM, so that in itself, right? That's kind of a bullish thing that there was enough action to touch the upper EM for the week after being flat. But we'll take what we can get and stay a couple points positive for the week. Let's go over to the news. So I want to get the stock stuff out of the way first, so we can look at some stuff that might be factored in to some moves next week, which is first things first. At 3 p.m. today, consumer credit came out and it missed, meaning that consumer credit was only $10 billion for July, and that was also down from a revised lower gain of $14 billion from the month before that. That was a miss of expectations. So $16 billion was expected, but we only got 10. So what does that mean? Well, from a month-to-month basis, yeah, I mean, we miss on this month's consumer credit, but the month before was okay. So for the quarter, things are okay for the quarter, but what the month could be telling is that, yeah, like it says here, overall credit growth is declining. And as to compare that, this month's performance to last year's, it was 28 billion. But what's going on now is that part of this consumer credit is, of course, credit cards. And credit cards are getting to the point where they're getting like maxed out. I mean, to the point where revolving credit card balances, it rose 9% this month, but only to find itself really in the history of credit card balances, there hasn't been more used in forever. So people are essentially living off, their credit cards because you're not using their credit cards to buy Louis Vuitton. If there was, Louis Vuitton wouldn't be down like a ton of percent, right? They're not. No one's going to Target. Okay, no one's buying things. Nordstrom just reported that no one's paying their credit cards. Macy's said the same thing, that the delinquency rates and credit card payments are going up. Non-revolving credit, especially typically auto and student loans, rose only 0.3%. I wanted to bring this up because, Tesla's an auto company. And this shows that the growth in auto loans is just not there. Like, there is no one getting loans. Like, no one wants to go to Tesla, and you're going to the configurator, then you're getting to the payment page and selecting your credit score, then being realized like I have to pay like 10%, 15% on an auto loan because I don't have perfect credit. And with perfect credit, maybe 6%. Not so great. And this is something I wish Tesla kind of could handle, is that a lot of these other auto manufacturers, GM, Ford, Toyota, whatever, Honda, they all have their own like financing arm, like a separate company or part of their own company that handles the origination of auto loans and has the ability to kind of finagle the interest rate on their loans that they're issuing to give a better deal, quote unquote, to their customers. Like, it wouldn't be surprising if on a 36-month term on an auto loan from, I don't know, Jeep, you can maybe get 0% depending on how good your credit is. And maybe 1.9% if you're just kind of marginal as far as credit score goes. Whereas Tesla has no real discounts in America for interest rates. And now I understand in the UK, they're offering very low 0% interest rates on the Model 3s because they need to get rid of them. That is their incentive. But that's the incentive that you can be offering customers, is that, and I'll show you a chart in a second, there is no savings left anymore. So the idea of people using cash to buy cars, that's not everybody. And that's not the majority at all. The vast majority now will be needing financing to buy these cars, and offering them low interest rates in somehow, some way would be beneficial. So the idea was that instead of legacy auto manufacturers using discounts to kind of reel people in for a deal, they're not really offering $10,000 off their car. They're saying, look, you can get an interest rate of like 0% if you just buy this car this month. Something that Tesla can think about, as far as not having to. We're not trying to deceive people with how we're trying to give them the savings, but instead of just doing price cuts all the time, there's other ways to handle this. But also in itself, having a Tesla financing arm has benefits. It has profit. People are paying you to let them borrow money. Now, the other side to that is delinquency rates, right? People not being able to pay can become problematic when you have a lot of bad loans on your books. But the reality is the income that GM GM financing brings in is hundreds of millions of dollars. Ford, hundreds of millions of dollars. Same thing for Toyota, hundreds of millions of dollars in net income, not just revenue. Revenues in the billions. So that was the consumer credit. So we hope that you kind of have to look in kind of two different ways. The lack of growth in consumer credit is good because the Fed and Powell doesn't want people buying a lot of things. So that's a good sign that consumer credit's coming down. That's why there wasn't some crazy reaction from stocks at 3 p.m. Because it was kind of like, okay, maybe this is confirmation that growth isn't really there. But at the same time, from a Tesla point of view, it's showing that people are not originating loans for auto. They're just not. And that's why at the end of the day, if you want to keep up volume to keep your factories going at a clip that keeps costs down as much as possible, you need volume. And the only way to create volume is to make these cars more affordable. So we can't hold that against Elon. Like, as far as you're cutting prices, you need to spend money on advertising. Advertising on what? Like, you want to spend money on advertising, but the problem there is that doesn't fix a situation that some people can't afford cars. Let's go over to X and look at some information regarding some credit card debt and personal savings. And so we can kind of understand that how Teslas are being purchased over the last year is going to be much different now. This is so from here in December 2021 into August of 2023, you can see there's just no money left over. I mean, there's no savings left over from the COVID peaks where money was being injected directly into people's bank accounts, into their quote unquote business accounts as well. There is just no money left over. And credit card revolving credit is just through the roof. And so, yeah, people are tapped out. It's getting to the point where the Fed needs to understand this. People are tapped out. What do you want them to do? Keep buying groceries on their credit cards? Come on. And some other information. Here's some breaking market news on X. 94 counterparties take 1.5 trillion at the Fed reverse repo operation. So you got to wonder, okay, so we know that earlier this year, we are something like $1.9 trillion were being kept in the overnight reverse repo with the Fed, which is a type of account that helps, lock in the floor of interest rates that the Fed is trying to make the economy suffer through. But anyways, so there was always this idea that when the debt ceiling was basically eliminated, that there would need to be an issuance of a lot of new bonds and bills to refill the Treasury General's account. And so where would that money come from? So it's obvious now that it was obvious back then too. It was obvious now that when the government needed money and it issued debt, the debt was being paid for by all these banks leaving money at the reverse repo. But this thing is draining at a clip from the past week of something like 50 plus billion, $70 billion. So where is that money going? Where is that money going? It's not necessarily going into stocks. It's not going into Tesla, especially. We know that for sure. So we're seeing the reverse repo come down and yields are going up on treasuries, right? I mean, bonds are going up. I mean, but the great thing about what you're seeing now is you're seeing kind of the short end. You're seeing the 2-year go up, right? Today, the 2-year outperformed the 10-year. 10-year was slightly up, but the long bond, 20 and 30 years, they were down a little bit, right? So you're kind of seeing that kind of curve flattening out. But anyways, so why are yields going up on bonds? Why is there so much outflows? I mean, the outflows on stocks are in the billions of dollars over the past couple of weeks, and you're seeing even retail investors getting out of their equity to the tune of hundreds of millions of dollars. So people are selling. They're selling tech stocks especially, and that's why you're kind of seeing how the Dow was outperforming. You've seen energy perform very well over the past 8-9 days, and banks were kind of flat instead of being down today. So, except for regional banks are not doing too great, and that's another thing that the Fed needs to really watch out for. It's okay, what kind of event are we looking at here when it comes to these regional banks utilizing a lot of the emergency programs that the Fed instituted after the SVB collapse earlier this spring, right? So they need to keep that in check. But we're seeing the reserves for these reverse repos come down. Where is this money going? It's going to something interesting. It's going to corporate debt. The investment grade issuance over the past, I would say, week, as you can see here from Zero Hedge, is around $55 billion. That was after another $5 billion issued yesterday. So the reverse repos are flowing into corporate debt. Unfortunately, some people can afford to issue debt at these interest rates, but a lot of companies cannot. Right? We're talking small companies who just cannot afford to pay people, 7,000% on their crappy debt. And so maybe for some companies, this is an opportunity for them to get some money. And you're seeing the reverse repo kind of do that, where reverse repo money's out, it's going into corporate debt. What was happening earlier this week? We were seeing some days, I think we saw the 2-year go up 2%, the 10-year go up 2% earlier this week, and all that money was going out of treasuries into corporate debt. So it's just that the positioning was kind of moving around, and it wasn't really going into equities from the looks of things. Though the market was relatively, flat-ish, but generally red over the past week or so. When it comes to Tesla news, Troy had a nice post here kind of showing a whole lot of cars to be exported from China, which would be exported to Europe. So most of these cars that the Model 3s that are being produced in China are at first being sent to Europe from the looks of things. But as he was saying, it's something what we want to prepare ourselves mentally for when it comes to Tesla's production delivery numbers for Q3 is that there was an obvious, and this we remember Elon kind of mentioned it, but there's an obvious delay in some maybe the production of the Model 3. There is no inventory in Model 3 for Chinese customers. It's possible that the ramp of the Model 3, even though it looks decent, like it still had to come up from a small number, and that the production numbers for Shanghai might not be that great. How does this affect delivery numbers? Well, these cars are not going to reflect, as you can see here from Troy's post, these cars are not going to reflect in the delivery numbers for quarter 3. We also know that the production lines in Giga Texas and Austin over there, they're not fully going at the moment for the Model Y and the Cybertruck. What if we don't get a delivery event? I mean, we haven't had word of the handover and delivery event for the first Cybertrucks. What does that mean when it comes to how, are we going to get any of these numbers onto this quarter's report? Maybe not. And so there's a lot of question marks being thrown around, and we just don't know what the production numbers and delivery numbers for quarter 3 are going to be, with some estimations being a slight lower number than quarter 2. How does the stock react to that? Because there's going to be kind of delay between production numbers and delivery numbers to quarter of our earnings report. So you just have to be ready to brace for a really negative reaction when it comes to those numbers, even with Elon kind of guiding lower for that particular quarter. But also kind of brings into question, how do these lagging effects affect Q4? That's going to be very, very interesting, especially as the economy gets very tight when it comes to the lack of credit being issued and what have you. So that's something that you should really be conscious about. And if there is a general pump for Tesla shares next week, you basically only have Monday and Tuesday, or even if things go really well on Wednesday, maybe Tesla goes up a little bit. But what you're looking for is to kind of, get yourself positioned for any big dramatic moves to the downside. I know we always preach about being hedged all the time right now, because there is just so much uncertainty when it comes to this company's short-term performance, that the moves to the downside are very, very brutal. They're very quick, and they seem to not be able to they're actually able to sustain themselves to the downside considerably, just as much as the upside. But you're looking for opportunities to get yourself hedged. How far hedged do you need to be? I don't know. I don't have an answer for you, but I think you need to do your own calculations to understand, okay, so if we make it through this week, this coming week, which will have CPI, PPI, and then into the week thereafter, which will have FOMC, which is going to be rate hike decision. That might be a nothing burger, just because most of the market is betting that there is no hike. And if inflation is really bad on Wednesday, you'll know immediately if there's going to be a hike or not, because if it is really bad, they might hike, and you don't have to guess about the week thereafter. But being hedged into the end of the month, and then start to consider, how are you going to hedge yourself for production and delivery numbers? How are you hedging yourself for the quarterly report? When it comes to those those really volatile events, you kind of want to get yourself to position to maybe sell calls against shares at that point in time when the implied volatility is very high, instead of riding volatility up with calls you sell now, only to miss out on all that premium that you could have netted if you would have just sold during that increase of implied volatility. So does that mean that for now, buying puts, like on Monday or Tuesday or Wednesday, depending on how green things could be, would be a better bet? It could be, and it can give you more protection to the downside on very large swings. Like, what does that look like as far as expirations go? Do you just maybe look for something towards the end of the month? It's possible. I wish I can give you a better answer. I can't give recommendations for that, but maybe puts are better for now. You could, and if you really need if you need funds to kind of secure some of those downside protections, selling a couple of calls against shares could give you the premium, give you some capital to work with to prevent much larger downside, depending on what type of movements you see Monday, Tuesday, Wednesday, right? We want to enter our shorts when they're cheaper, just like how, Ford was up today. And I wouldn't be surprised if a lot of people were hedging their positions in Ford, or simply looking to play a downside move for Ford coming into the middle of the month, or towards the end of the month, as the negotiations start getting really heated with the UAW. Now, I mentioned earlier that Walter Isaacson, the person who wrote Steve Jobs' biography, who did biographies on some other figures like Leonardo da Vinci, his book is coming out very, very soon. And it's going to be out September 12th, as you see here on this article. And so we've seen snippets. And if you're watching the news or if you're reading Twitter or X, you're reading snippets about Elon and the Ukraine. You're hearing snippets about what this article is about, robotaxi, the new generational, the new model, the new whatever vehicle. How do they call this again? But whatever it is, the new one. Okay, guys, the new one. So a lot's going to come out about Elon. And we know how him as a person can easily affect the stock. We're seeing how his choices when it comes to Twitter, company that's not even associated with Tesla directly, can affect Tesla stock price. So we have to understand that him as a central figure to these organizations, information that comes out about him can easily affect your shares in the short term. Just know that, understand that. And with this book coming out, it's going to give a very personal perspective on Elon. This Walter Isaacson is with him through all of these really top secret meetings from the new vehicle that's going to come out, which is going to be, if it's going to be called Model 2 or Robotaxi, they call it Robotaxi internally, from his meetings with for the purchase of Twitter, his decision making when it came to purchasing Twitter. He was there for SpaceX and Starlink discussions as well, even ones with in regards to Ukraine and probably negotiating with the government, our government as well, to provide that service. So this is going to have a very intimate perspective on Elon and could affect the Elon story as we get into next week. This is going to kind of line up around some of our economic data drop dates as well. So there's this article from Axios is something I think you should read in its entirety. It has a really awesome view of how Elon's approaching this new vehicle. And so first things first, he was really adamant about the new Tesla car that was originally going to be made in Mexico not have steering wheels, not have mirrors, not have pedals, because the idea was that they don't call this Model 2. They don't call this compact car. He literally calls it, and I think he might be the one leading the charge for this. He calls it Robotaxi, with the idea that this car was going to be a Robotaxi from the get-go, not a car that you're driving yourself or have any ability to. And his lieutenants, his executives, especially lead designer, and was it Lars? I believe he works in safety. So Lars and France were really pushing back against this vehicle designed specifically for autonomy. And Elon and them had some really heated exchanges in regards to this. But so France was saying in this highlighted area, if we go down a path of having no steering wheel and FSD is not ready, we won't be able to put them on the road. And so he's saying basically like, yeah, it's like you're really, pushing the envelope when you want from the ground up a car designed to be fully autonomous. Because what if we don't have FSD 12 in full release? And then the whole point of this smaller car was to be something that other countries can afford if they're not economically equivalent to the United States or to China or what have you. If they're not as prosperous in that sense, they can't afford a car that's like $35,000. We need to get into the low 20s before incentives, so everyone can afford the cars that we make that are awesome for the environment, that are software based and have great performance for the money. So the thing about it is, like, if you can get a car that could be designed as a full self-driving car and a car that just a normal person drives, France and Lars are really kind of pushing that idea. Then you can kind of hedge your bet, is what they're basically saying, is that, okay, so if we don't have full self-driving approved and we're actually just even ready to release, forget the approved part, then we have a car that we can sell to everybody that has a steering wheel pedal, and we don't have to figure out how does a fully autonomous car, handle paying for a toll, paying for a parking ticket, getting into a gated community that doesn't have a clicker, or you need to push codes into an interface of some sort to get in. You don't have to worry about that right now. But you kind of design the car to be built on the same assembly line. So that's what Franz was really pushing. But Musk was like, no. As you can see here, he wants no mirrors, no pedals, no steering wheel, and he's adamant. This is him. These are his words. This is me taking responsibility for this decision. And they basically said back in response, we'll get back to you. He got very, very upset. And this is kind of the same probably. This is probably his same mood and same tone when the design team was pushing back against the Cybertruck being very DeLorean-like, very futuristic, very straight-angled and straight-edged. He says in response to this debate about the robotaxi, let me be clear, this vehicle must be designed as a clean robotaxi. We're going to take that risk. It's my fault if it F's up. But we're not going to design some sort of amphibian frog as a halfway car. We're all in on autonomy. Now, I mean, the thought process is great because it's really, like I said, you're kind of pushing the envelope on what a car could really be. And I think that, like, it's kind of like if your boss asks you to do something impossible. The reason why your boss is asking you to do something impossible is because he doesn't want you to achieve the impossible. He wants you to just achieve as much as you can because of the pressure that's being put on you. And I can appreciate that, Elon's really pushing his team to make something. What he says is this will be historically mega revolutionary as a product. It will transform everything. This is a product that makes Tesla a $10 trillion company. People will be talking about this moment in 100 years. Basically, kind of similar to Henry Ford and the advent of the Model T being mass produced. This is kind of the same sentiment when it comes to that. So Walter Isaacson goes on to say that he's being really stubborn about this, and eventually he relents. And in the summer of 2022, after saying he's all in on robotaxi, Lars, Franz came back to him with this kind of what they said, new information about what they can really do. We brought him new information that maybe he wasn't fully digesting in the summer. Even if self-driving vehicles are approved by regulators in the US, he argued, it would be years before they are approved internationally. So it made sense to build a version of the car with a steering wheel and pedals. And that's true because even look at it now, FSD is not available in other countries. Maybe we're close to getting some type of approval from their kind of equivalent NHTSA, I don't know what, other than NHTSA, what could it be? Maybe the Transportation Commission. Do we have one of those? I don't know what we have. But otherwise, if we don't have approval from their equivalent of NHTSA, you're not having self-driving in Europe and China and in those big markets. So, you need to have this car being widely adopted because you can make a robotaxi and let's say it's only available in the United States, but you defeated the whole purpose of having this new model. This new model is cheap, but also requires volume. It needs every market to be able to buy and use it, not just it be a robotaxi, right? So on a late Wednesday evening, September 22, Musk kind of locked himself and his team in a secret meeting in the Fremont factory, and they presented data about if you want Tesla to grow at a clip of 50% a year, you need to have a small, inexpensive, regular car. And this is what I'm getting at with this article is the crescendo of this. Basically, the ultimate is that we've been worrying about Giga Mexico in Nuevo Leon not having a groundbreaking yet, without having permits done, with Chinese suppliers being told that they don't have to have a huge rush to set up a supply chain in Mexico to support the new Giga Mexico factory. So why is that? Well, what happened was towards, I think, May of this year, Elon came to this decision that, okay, he likes what they designed, pitched to him, which was a small car that has a Cybertruck futuristic feel. Walter goes on to say that Musk loved the designs. When one of these comes around a corner, he says, people will think they're seeing something from the future. The new mass market vehicle will have a steering wheel and pedals, but also be a robotaxi. And now they're calling it their next generation platform. Musk initially decided that Tesla would build a new factory in northern Mexico, 400 miles south of Austin, designed from the ground up to build such cars. It would use a completely new manufacturing method that was highly automated. But soon a problem arose. He had always believed that Tesla's design engineers needed to be located right next to the assembly line, rather than allowing manufacturing to be done at a remote location. That way, engineers can get instant feedback on how to design innovations that would improve both the car, but also the assembly process. So in May 2023, this year, he decided to change the initial build location for the next generation cars and robotaxis to Austin, where his own workspace and that of his top engineers would be right next to the high-speed, ultra-automated assembly line. So now we have some clarity. Like we're not seeing any movement over in Mexico, and I think Mexico kind of messed up on this respect. They had March and April to figure this out before May, and that decision was made by Elon to start production of these new cars. At least design the assembly line in Texas. Mexico doesn't have the opportunity to do that anymore. They're not going to have the talent that's going to be there to do it. It's all going to be located centrally in Austin, where Giga Texas is now. They're just going to expand that, and maybe it could just kind of, go slow motion on building out other factories. And I think, and we talked about this before. We talked about this a couple months ago, where the idea that we need other factories to be built to expand the Tesla's production capacity. I think it was, it's for Tesla Hyperbolts, it was a really neat idea. I'm sure that we can expand production by producing cars in a low labor cost environment like Mexico. But think about this. He went on to say over and over again in this book that Elon was focused on a highly automated assembly line. Highly automated. Basically robots building his robot car. And why would you need low-cost labor to do that when you have the facilities already to produce cars that are not being fully utilized from my perspective? Except for Fremont, that's just like, we don't need to talk about Fremont. But from Giga Texas, we have Giga Berlin, we have Shanghai. All of these facilities already have an existing tested and tried and true supply chain around it. And that's what's really important. And that's what hurts a lot of other manufacturers, is that the supply chain not being maybe centralized, maybe the supply chain not being efficient. But those three facilities are not necessarily running at a full clip. Okay, so if we want 30 to 40% growth year over year, okay, we're on track right now to produce 1.8 million cars for 2023. And if we want to grow 35, 30, 40% on top of that, maybe we need to be somewhere around 2.5 million, right? For next year. But you're telling me that we can't do that you're telling me that we need to build a whole new factory or two to do that? I'm not necessarily sure we need to, right? How about we just tack on a new, what's the difference between expanding Giga Texas or Giga Berlin or Shanghai, just like they're doing over in Brownsville, over at SpaceX headquarters, where they're building Starship. They're already expanding their Star Factory to a factor of fourfold what the current manufacturing size is for the actual Star Factory building, not just the tents and what have you that is out there. So expanding what we have now, keeping your supply chain local and just there, maybe bolstering it a little bit, and not having to have your suppliers spend hundreds of millions of dollars and yourself, because we know right now money isn't cheap. And I understand that Tesla has $23 billion in cash. They have positive cash flow last quarter, even with spending a lot of money capex when it comes to building out new facilities. What are we building? We're building cathode facility. We're expanding potentially Giga Berlin. We're also building a lithium refinery thing. We're spending billions of dollars on AI chips from NVIDIA. We just finished the design of Dojo and starting production on Dojo. We have to build out data centers, and we know that Tesla's acquiring and building data centers across the world to store data, to get data that needs to be localized in China or what have you. There's a lot of costs that are going involved that are not just gigafactories. We have a Megapack factory being made over in Shanghai as well. So there's a lot of money that's being spent. And I think a really judicious look at how we're spending that money is appropriate right now, because this is the environment. Rates really high, money is very expensive, and everyone keeps saying we need to spend money on buybacks. I think Gary Black's been talking about buybacks, and we need to spend $10 billion on buybacks because the return on that would be more than any other investment you can make in Tesla. I hear that. I'm not saying you're wrong, but keeping a nest egg is really important right now, because we're going to be spending billions of dollars next year on compute as well. So maybe $2 billion, $3 billion within 1 year being spent on AI and data centers and the networking and the buildings that store it and the electricity that needs to run it. It's going to use a lot of electricity. It needs a lot of cooling. These are capital intensive projects already. And what we need full self-driving first. And then that can justify almost anything you need done, from building factories for robotaxis or what have you. But it's smart that we just work with the factories we have now, expand their capacity at the gigafactories in Berlin, Texas, and Shanghai. They've already been in talks with local government in Shanghai to try to acquire land around the Giga Shanghai factory. We're going through the public discussion process over in Brandenburg and Berlin in regards to expanding that factory as well to almost double the production capacity for a plant that's not being used to its fullest already. There were rumors, a couple of weeks ago, saying that, firstly, they don't have 3 shifts running for Giga Berlin. And the 2 shifts that they're working at are only producing 60% of what they could be. There's a lot of capacity at what we have right now, and producing the car in a highly automated factory doesn't mean it needs to be made in Mexico. Honestly, it doesn't. Like, you don't need to hire Mexican workers because the labor's cheap and have it done in Mexico for that particular reason, to keep costs down on a car. If the majority of the manufacturing process is highly automated, roboticized in some way, you don't need to have it done in Mexico. So I wouldn't be surprised if you're going to see nothing happen there for some time. And instead, what we're seeing, and even this is maybe even better, you're going to just watch all the people watching Giga Austin, Giga Texas, and watch them, bring in all these maybe new machines, new robots, what have you, and start. We get to witness firsthand the construction of the next generation's assembly line local to America. And I think that's going to be a better bet for now, because it keeps costs low, where we don't need to be spending billions of dollars making some factory in a country that doesn't appreciate Tesla choosing them to make a factory. If they want to like kind of not like, I'm not asking them to expedite permits to a point where it's irresponsible. I'm simply saying is that there hasn't been movement since the beginning of the year on that, and there is no groundbreaking. There is no machinery prepping grounds in Mexico. I think you just have to say, like, that was simply Giga Mexico was a negotiation, like a little piece of a negotiation that you can leverage against other countries, and as well going around to other countries over in India, even talking to Indonesia or what have you. All of these things was just a way to play countries against each other to see, what type of benefits you can get from the current manufacturing facilities you have now, right? So if you have Shanghai, you have Berlin, you can tell these countries like, hey, I'm talking to France right now. France wants me to build a factory in their country, and they're willing to give me this type of price tax break. They're going to give me this type of incentives. They're going to give me like no import tax on the vehicles if I need to send them out, stuff like that, right? His kind of like all those trips to other countries, I firmly believe that they were just there to leverage against China and Germany and say, hey, I want to build out these factories, but I want a better deal. And that's common negotiation tactic, right? You're showing your interest in other countries, but the reality is you just want to keep things efficient. You already have these great supply chains already built up in China, Texas, America, really, and over in Germany. Just keep it that way for now, and I think we can max out that capacity without having to spend $3 billion making some factory. We don't have to spend, and we can keep Tesla can keep the production and the assembly line process and all that stuff for the next generation model under wraps and local, and something Elon can easily visit whenever he's at the factory over in Texas. And he's probably going to be in Texas a lot, Texas or California. So I think that's a better move. And that's why I kind of wanted to get the chart stuff done in the beginning of the video, because I know I was going to ramble about stuff that you might have not been too interested in. But I appreciate you guys hearing me out. What we're looking for next week, just as a small recap, what we're looking for next week is really just a way to enter. We want to see some kind of bullishness on Tesla so we can get some hedges in, right? I got one hedge in somewhere in the area of when it was breaking down. I want to say when it was break even for the day, I got one small hedge in, for next Friday. And I think I have a couple for end of month puts. As far as calls being sold, I only have one call sold against shares because, like I mentioned, I'm kind of looking for a better entry for the calls for now. But hey, oh, look at that. Tesla isn't negative in the after hours. That's something. Anyways, yeah, so if we can get over to the 260 area, that's kind of where I would be more comfortable selling calls, because I do think that that's a reasonable number to achieve if there is some bullishness in the market. Because, yeah, I know Tesla's a little bit flat, but just the index is as well. When the SPY and the QQQ, they're not really performing all that great. So if we can see some buying in those names and in the index, maybe Tesla can ride that wave up a little bit. And they're not, from an RSI perspective, they're kind of oversold, right? Like the S&P 500 is not looking fantastic. If you want to just kind of map some indicators on the market, we can just do that real quick. Let's look at our EMAs and see how we're interacting. Like we're closing below the 20. And that could not be that great for the market. I guess that's something to think about, right? It could be not that great. I think falling below our little orange line after testing it from the day before could be a little bit problematic. Closing above the 20 would have been much more preferred. Let's see how Monday works out on that. We can do the same thing with Tesla if you're just interested to see what that would look like. We look at our EMAs and see where the 20 lines up. So actually, we were kind of rebounded off the 20. So yeah, I mean, from Tesla's perspective, we're looking okay-ish for now. Closing below the 20 would be bad, right? So we're talking about closing somewhere in the range of like 245 come Monday. We would have to really consider not waiting for a upwards move to enter some type of hedge into our portfolio. So kind of keep that in mind. 245 might be bad come Monday, come Tuesday. And obviously 245 is not that far away. It's less than 1% away from where we're at right now. So we're just trying to stay afloat, right? We're just trying to keep our head above water. But try to have a good weekend, guys. Look out for maybe more snippets from Walter Isaacson's book before it's being released. Look for some information about Cybertruck delivery event. Kind of keep out an eye out, maybe if you're interested, if you'd like to follow Tesla closely, how Model 3 deliveries are going over in Europe. Are they being available for Chinese consumers? How is the stimulus for other countries like China especially working out? You're probably hearing about kind of rebates and tax credits for cars over, was it Hong Kong or Shanghai? So there is some potential for some emerging market ex-USA kind of stuff that could affect the action come next week. But CPI is going to be everything. So if we stay flat for CPI, basically it's the market saying they don't want to give you an opportunity to really enter into anything before the inflation report comes out. All right, guys, have a good night and have a good weekend. Thanks so much.